And joining us now to help us put it all together is Phil Angelides. He's chairman of the Financial Crisis Inquiry Commission and frequent guest. I'll call you a frequent guest here now on Fast Forward. Good to see you, Phil, as always.
Good to see you.
Thank you. I know you're still beating the drum on sort of the causes of the financial crisis, and many people have not sort of owned up to it, nor have they paid for it, namely the banks. But let's move forward past that for just a moment, because the banks are still very much a part of fixing the housing crisis. What do you think is the first thing that needs to be done?
Well, actually, the banks, unfortunately, aren't doing enough to fix the housing crisis. And you're right, Lisa, this is weighing down the whole economy. I mean, there's 11 million homes underwater. About a quarter of the homes in this country that have mortgages are underwater, and about another 2.5 million that are on the cusp of being underwater. And it's a tremendous drag on the economy. Families are laden with debt. Families can't sell their homes to move for job opportunities. So I think there's a few essential steps. Number one is, look, we don't want to return to the loose and crazy credit standards of the decade of the 2000s, but we do need to loosen up credit so that credit-worthy borrowers who have an ability to pay can refinance, and we need to be much more aggressive in that regard. That's number one. Number two is, I think we need to be much more forceful now about modifications. There are millions of people who can stay in their homes if they have principal reductions. There are millions of people who, rather than go through a foreclosure, could do a short sale if the banks, the first and the seconds, would cooperate. And I think in this regard, we need much more forceful government action. And frankly, Lisa, if it doesn't happen, I think Congress ought to reconsider cram down legislation that allows bankruptcy courts to be able to reduce mortgages, because this underwater situation, this paralysis in the housing market, is devastating to our economy. And then thirdly, Lisa, I mean, we do over the long term need to put in place reasonable government supports for a mortgage market that can function well. And also, I think the final thing I think we need to do is we need to have some very strong neighborhood stabilization efforts. For example, Fannie Mae and Freddie Mac have foreclosed on 290,000 units. They're paying an enormous amount. They don't have a property management capacity. These homes are neglected. They're deteriorating. We ought to have some innovative programs like rent to own, so that people, if they can't pay the mortgages, have an opportunity to rent homes with an opportunity to repurchase them, perhaps with government having equity sharing. But we've had a very anemic policy to right the housing market. We need to get much more aggressive, much tougher. And the last thing I'd say is, look, I think the banks really need to recognize reality. They haven't written down their second loans or their home equity lines of credit. They haven't written down their first mortgages. They need to do that on their books, and then they need to give relief to homeowners.
Why haven't the other refi programs, though, or the other modification programs been as successful? I haven't looked at the most recent data, but, much of the data that I have looked at just in the past year suggests that a lot of these loan modifies or loan modifications haven't resulted in a better situation for the homeowner. Often they're delinquent very soon after getting the loan modified.
Well, so first of all, a lot of the modifications haven't even happened because there's still the wars between the second lien holders and the first lien holders. And with all due respect to a lot of the second lien holders, the big banks, J.P. Morgan, Wells Fargo, B of A, Citigroup, are clinging to those seconds that have no value. Obviously, it's been hard because so many of these mortgages were sliced and diced to get the modifications done. The servicers, we've tried to incent them, but frankly, the incentives haven't been aggressive enough. There are, look, a slice of homeowners in this country that if they got modifications, principal write-downs, could stay in their homes. There's going to be a whole slice that can't because they've now lost their jobs because of this economic downturn. But we could be doing a lot more, having a lot more success. But one of the keys here is significant principal write-downs, and that's not happening. And frankly, I think that has to be forced. Now, some people have said, well, that's a moral hazard. Lisa, we're way past that point. I mean, someone's drowning in the lake. You don't not save that person because you're afraid the next person might jump in the lake. We are in an economic crisis, and we need forceful action. And frankly, the servicers, the trustees, and the banks aren't moving. It's like a block of ice, and it needs to be cracked open.
Is there just not the political will at this point, Phil? When we're speaking about the current administration, does he just not have the political backing any longer to push sort of a forceful solution to this?
Well, let me just say this, and not enough has been done. I personally, look, I come from the business sector, but the bankruptcy laws, we always amend them to favor, the business side, the creditor. The only people in America who can't take advantage of these bankruptcy laws are individual homeowners. I would have pushed through cram down legislation. That would have moved the ball. I do think that, for example, the Fannie and Freddie need to work to help refinance mortgages. Right now, they're reluctant to refinance underwater mortgages because they're saying, look, I got a $200,000 mortgage. I'm getting paid 6%. Why should I take that down to 4%? But pretty soon, if you don't do that, a lot of those folks where the homes are worth a lot less than $200,000 are going to walk. So I don't, just across the board, we need to mobilize. I think it's a matter of political will, but it's also a matter of everyone realizing that in many respects, this is a crucible for getting this economy going. And, Lisa, as you mentioned, 3 years ago tomorrow is the day Lehman collapsed. And here we are 3 years later, a quarter of the mortgages underwater, 4 million foreclosures, millions more on the way, 24 million people out of work. We're not doing nearly enough to push stimulus. Yes, I know that's a politically toxic word, but it's just the reality. Not enough to push stimulus into the economy, into the housing market, into the job market. And if we don't create demand, lessen debt, we're going to be in for a very long season, like Japan, perhaps worse.
Well, we've had a number of economists on here, no matter which way they lean sort of politically. It seems like lately the unanimous opinion is that housing has to be fixed before the economic recovery can really pick up any steam. And so I have to believe that everyone in Washington, no matter what side they're on, wants an answer or a solution to the housing crisis. And it's hard to pinpoint exactly where the problem lies or why a solution hasn't been found. But I also think it's hard to have a winner out of this without having a significant loser in this. So if you do some of what you're proposing and you hurt the banking system, you want to cram down legislation that forces them to take principal reductions, doesn't that weaken the banking sector, which has already gotten much weaker this year? Doesn't that also put them in a position where, when it comes to small business loans, when it comes to other homeowners, they're not in a position any longer to make those loans?
Well, so first of all, they made bad loans. And, the fact is, in the end of the day, there were a lot of reckless borrowers. But in the end, it's the responsibility of the lender. They take the risk of the loan. But let me just put some numbers out here because, frankly, I think the data suggests that the banks could be doing a lot more. The 10 top banks in this country, who now control 77% of the banking assets, they have about $600 billion in tangible common shareholder equity. They have the ability to take some of these losses. And frankly, if they have to raise more equity at the expense of shareholders, so be it. They're not suffering that much. They've been paying billions of dollars in dividends. Last year, the top 10 banks had profits of $62 billion. They've got to disclose the compensation to their top 5 executives. And among those top 10 banks, you add it all up, and it's about $500 million. So frankly, yes, I think the banks are going to have to take some hits. And let me just say something, Lisa. Homeowners and the American people have taken enormous hits. So I don't believe that's the principal concern. I will also say I think there's some important legal cases moving through, like the Attorney Generals of the United States are moving to get a settlement from the banks. And I hope that that moves forward without broad waivers of liability from the banks so that we can have principal reductions. But we need to lower the debt load on the American people so that we can get this economy moving again. And frankly, the banks need to participate. Now, you said you'd think everyone would be for this, but I see, frankly, sadly, some very toxic politics in Washington where a lot of Republican members of Congress seem to be acting like if it gets worse, it's better for them, but it ain't better for the country.
All right, Phil, we got to leave it there. Thanks so much, as always, for joining us here on Fast Forward. Always appreciate your opinions on these matters. That was Phil Angelides, chairman of the Financial Crisis Inquiry Commission.